For a little bit more on what's happening in this market, let's bring in Keith Lerner. He's the Chief Market Strategist over at SunTrust Advisory Services. And Keith, just when you look at today's tape, certainly we'd seen some relative weakness over the last couple of sessions, but a 5% decline on the S&P certainly seems to come, at least from my vantage point, a little bit out of left field. What do you make of today's action?
Yeah, no doubt. It's an ugly day. And I will say, over the last week, especially after that employment report, we definitely saw some complacency come into the market. You saw, as far as the demand for downside market protection, plummet to the lowest level in several years. So I think it's a combination of things. One, we've had this tremendous run up over 40% since the March lows. You started to see some complacency come in. The employment numbers really started to lift expectations that this economic reopening was going to be very smooth. And I think today with the news on some of the coronavirus cases spiking, that's challenging that view. But just for perspective, this market was running at the sharpest pace of any bull market since 1950, even stronger than 2009 or 1982. So our thoughts is that we're more likely to start moving more to this choppy phase, more of a reset or a gut check. But as we spoke in the past, Miles, recently, the breadth we've seen off the lows do suggest we are in a bull market that just got extended on a short-term basis, and again, might have to have a little bit more of a correction in time and or price.
Keith, Dan Roberts here. As we look at the damage today in stocks, I mean, are you surprised that there wasn't a longer bump from kind of the positive sentiment we heard yesterday out of Jay Powell? I mean, Miles wrote about it this morning in his newsletter, but the suggestion yesterday that the worst of it had passed, I believe the phrasing was the worst first order effects have now passed. And a lot of people saw that as a good thing, even though obviously there's still so much more to recover. And I think people kind of expected that maybe stocks would benefit from that today, from the optimism we heard yesterday from the Fed.
Yeah, well, I guess in it by itself, that was a cue that the market did not rally based on that news. And even like yesterday, what you saw is even though it was much sharper today, you saw a rotation back into the FANG names. Technology was going back towards leadership. So you saw a little bit of a cue of a market shift yesterday. It just came so much quicker today. And again, I think this has happened when stocks were vulnerable. In fact, even though we're down 5-6% today, where are we at? We're basically back where we were about 10 days ago. That just shows you this last move up was so strong. And I think this last part of the move is where the froth came in. And because of that, even in our own portfolios on Monday, we rebalanced. We took some profits off the table in equities and increased a little bit in fixed income. But again, we have to know this, any market isn't going to be a straight move up. And there's still a lot of uncertainty with the coronavirus. And you can, again, even in a bull market, you have to expect ebbs and flow.
And, Keith, just a little bit related to kind of what Dan was asking, and I think the banks are under pressure today, obviously, because of what we heard from the Fed yesterday. And the banks had really been the linchpin of that cyclical rotation we'd seen in the market. Does this kind of move maybe question in your mind whether that rotation can continue and whether that was maybe a false start on folks looking at a more positive economic backdrop?
We have a growth tilt in our portfolios, and it was painful to see how sharp that value rotation. We want to still see more evidence that that's actually happening. We think it's still premature to say that value's taken over the baton, because you are going to see an uneven economic recovery, and in that environment, we still think investors will pay a premium for growth. So I think the main thing is a lot of these stocks that went up way too fast now come back. They should be on the watch list to see if they start to hold on pullbacks towards support levels. But at this point, we're sticking with our modest growth tilt.
Keith, how much of this has to do with the Fed, and then comparing that to how much of it has to do with this rise that we're seeing in a number of cases for some states? Because I think investors are kind of struggling balancing the two and exactly what that means for the short term, and of course whether or not that's going to lead to an even bigger increase in volatility.
I think it's a bit of both, but I will say it's one of those things where a lot of the clients that I've spoken about with, they've been really concerned about the coronavirus. And then we went after Memorial Day, and people saw folks out, and then a couple of weeks later, we still didn't see much of a spike. So I think people say, well, maybe this is behind us. Maybe this coronavirus is behind us. And I think just the numbers changing on the margin the last couple of days has caused a reset, a reevaluation, saying, okay, this is not completely over, and the market is now basically digesting that and pricing in a little bit less rosy scenario. So it's a combination of both, but I definitely think it's more geared on this coronavirus spike that we've seen the last few days.
All right, Keith Lerner with SunTrust Advisory Services. Always great to get your thoughts. We'll talk to you soon. Thanks so much for calling in.
Great, thank you.